The markets were sure a rate cut was coming. Wall Street was ready to celebrate. And then, the Fed said no. Against all the noise, Chair Jerome Powell held rates firm. Again. Why? What's the real story behind this pause? And what does it mean for inflation, jobs, and your money? Let's break it all down and reveal what the Fed isn't telling you. Part 1. The Fed's Decision. What happened? On June 18, 2025, the Federal Reserve voted to keep the federal funds rate unchanged, marking yet another pause in its rate policy. This move wasn't a surprise, but it still left many wondering, why hold now? What are they seeing that we aren't? To understand this decision, we need to look at the three pillars the Fed always considers. 1. Inflation. 2. Employment. 3. Financial stability. Let's break these down. Part 2. Inflation, still too sticky. Despite cooling from its 2022 peak, inflation in the U.S. is still above the Fed's 2% target. Core inflation, excluding food and energy, remains around 3.4%, with housing, services, and healthcare costs keeping price pressures high. The Fed's concern? If they cut rates too soon, inflation could bounce back. So even though the trend is downward, it's not fast or convincing enough to justify a cut. Part 3. The labor market. Surprisingly resilient. Here's the twist. While inflation is still elevated, the job market remains strong. Unemployment is hovering near 4%, and job creation continues in sectors like healthcare, construction, and tech. In the Fed's eyes, this gives them room to wait. If the labor market were weakening fast, they might feel pressure to act. But so far, it's holding firm. So why rush? Part 4. Financial conditions. Already easing? Another key reason the Fed held rates. Financial conditions have already loosened. Even without an official rate cut. Mortgage rates have come down slightly. Bond yields have fallen. Stock markets are near record highs. The Fed doesn't want to pour gasoline on a market that's already heating up. If they lower rates now, they risk reinflating bubbles in housing, equities, and crypto. Part 5. The Balancing Act. What they're watching. Jerome Powell put it bluntly. We're not there yet. The Fed wants to see a clear, sustained decline in inflation, no resurgence in wage pressures, and data across multiple months, not just one good CPI print. In other words, they need more proof. They also want to avoid the mistake of the 1970s, cutting rates prematurely, then having to hike again when inflation flares back up. This time, they're determined to get it right, even if it means waiting longer than Wall Street wants. Part 6. What happens next? So, where do we go from here? Markets are now pricing in potential cuts later this year, possibly in the third or fourth quarter, if the data cooperates. But that's a big if. Here's what to watch. 1. Monthly CPI and PCE inflation numbers. 2. Unemployment claims and job openings. 3. Consumer spending trends. 4. Corporate earnings and credit conditions. Any surprise spike in inflation or a downturn in hiring could change the calculus fast. Final thoughts. The Fed didn't cut rates, and that sends a clear message. They're not driven by headlines. They're driven by data. Jerome Powell and team are walking a tightrope, trying to tame inflation without choking the economy. They may not have moved rates this time, but don't mistake that for inaction. Every pause is a message. Every hold is a signal. The question isn't just, what will the Fed do next? It's, what should you do to prepare? Stay tuned, stay sharp, and stay ahead. For more breakdowns like this, hit that subscribe button to Finance Related 101, where we turn global economics into straight talk. Thanks for watching.